Good afternoon and welcome, everyone. Thank you so much for being here with us. I'm Rachel Nabers from Nabers Group and Solo 401k. With me today is Artem Milinchuk from FarmTogether. As we get started, let's just do a quick technology check. We want to make sure that you can see us and hear us just fine. On the right-hand side of your screen, you should see like a chat bar. Go ahead and tell us, yes, we can see you. Yes, we can hear you. And tell us where you're joining us from. Looks like we've got people from all over the country, which is awesome. Bert, hello, Bert. Dan, Sarah, David, Phil, Howard, New Yorkers, Palm Beachers, Santa Barbara, DC, Napa. It's really awesome to have you all here, and we're really glad that you have carved out some time to join us today for a really important topic of discussion. I think now more than ever, people are really wondering where they should consider investing. I know people have been throwing around the word unprecedented so much that it just kind of goes in one ear and out the other these days. But it's true that as investors, we want to know what our options are and what do we have that's available to us. So that's what we're going to cover today is one option that is available to you that you might not have even considered before. And we'll get in here just a moment. I just wanted to say, as we're getting started, you know, farmland is kind of one of those, it's almost like a mythical kind of an investment where normal people don't necessarily know that we even have access to it. I mean, do you just go up to a farmer in a field and ask him if you can invest in his property? Like, how would that deal even work? That's part of what we're going to discuss today, a need in the market that Artem identified and created a solution for. So without further ado, I'm going to go ahead and share my screen. Artem and I have a presentation ready for you. And thank you, everyone, for letting us know you can see us, you can hear us, and it's so awesome to have you here. We'll go ahead and get right into it now. And you should be able to see my screen. And Artem, go ahead and take it away.
All right, fantastic, Rachel. Thank you so much. Thank you, everyone, for joining us. Yeah, truly unprecedented times. I see a few people like myself joining from San Francisco right now. We have this apocalyptic view, Blade Runner 2049, and just everything we've gone through this year. I mean, it's been truly crazy. I come from the investment industry. I worked for 10 years in finance. I was investing in food agriculture, both for large pension funds as well as smaller private equity funds, family offices. And really, to me, farmland was seeing how attractive this asset class is, and we'll talk a little bit about it, but it's really a solution. You know, when they say build something that you would use, or another question they ask is this something that you would put your grandparents' money in? And, you know, the answer to both of those is, you know, hell yes, and I do it right now. And really, it's, you know, we'll get into why farmland, why it's exciting. It's just amazing how, you know, Rachel, as you said, something exotic, but if you think about it, you know, our civilization started with agriculture. For the longest time, you know, your wealth would be measured how much land you had. And it's so critical to our very being, and especially farmland being intricately linked with water in a lot of ways, where you're investing in farmland, you're investing in water. And then B, you know, with climate change, farmers actually can be a huge part of the solution, actually being on the offensive with climate through regenerative agriculture. So let's jump right in. So FarmTogether, we're a data and tech powered platform for farmland investments. And, you know, the reason that data and tech is really important here is because it is such a fragmented market with very opaque market. Information is hard to come by. And so in order to access it at scale and to really give you the same tools and the same transparency you have in, say, stocks or real estate, you know, data and tech is essential. It's, you know, 2020. So there's no reason that we shouldn't be applying the latest technology and investing in this oldest asset class. And so that's why I think it's really exciting marrying the two. Our vision is to provide all investors with access to farmland and provide farmers and farmland owners with access to capital. And, you know, as I mentioned, it's really live on a tiny planet. I mean, every day we just see how connected we are, and there's no getting away from it. You know, we're all neighbors on this little blue dot So we recognize farming is the single most vital industry on the planet. And so we want to make sure we drive sustainable and prosperous food systems that work for everyone. Just a little disclaimer, the usual legal disclaimer. We can leave it here for 15 seconds. I know it's the most exciting part of the presentation. So.
Well, and everyone here, we have a lot of self-directed investors with us today. So you guys already know, always do your due diligence. Make sure that the investments are in line with your risk profile. We want to provide you a lot of education, opportunities to learn how to expand your portfolio, and always do what's right for your own portfolio after doing your own due diligence.
So starting with a little bit about the team, I think it's important before we jump in to establish some context, some credibility. So I talked about myself. The members of the team include David Chan and Josiah Terrell-Perica, both with substantial experience in ag and farmland investing. Josiah worked for one of the largest institutional farmland funds, Prudential. David was at Prudential as well as Amera, a private equity fund investing in ag. And then Olga is our part of the technical team and product team. So she does a lot of the magic around both the website and analyzing farmland. Something that's really important to mention is becoming a larger and larger part of our mission and our deals is playing to farmland strengths, which is a powerful engine for impact. It impacts 8 out of 17 UN's SDGs, or Sustainable Development Goals. Around social, economic, environmental factors. And so you'll see more and more of that coming to play. It's still in a lot of ways an industry that's emerging, and the measurements, how you actually measure the impact, how you drive the impact, it's still fairly new, but we hate greenwashing at FarmTogether, really focused on actionable results and clear measurable results. And so when we have those deals, which we hope will be very soon, you'll see them on the platforms. You'll also be able to do well and do good, as they say. So let's jump now. Why farmland? First of all, just talking about the need, where is this even coming from? There's a mega trend that has been happening for the last 40 years now, which is investors are in dire need of yield and diversification, especially today. And this goes for insurance companies, for pension plans, and for credit investors. And really, the interest rates are where they are. A lot of asset classes correlated, as we saw in 2008. We're seeing now diversification is harder and harder to come by. And so farmland, I think, you'll see solves that problem. So this is just another slide showing the forecast of alternative investments growing. Part of the reason farmland is opening up is a broader trend of alternative investments opening up, whether it's real estate, infrastructure, cryptocurrency, what have you, anything that go beyond traditional stocks and bonds. And the growth has been phenomenal. I mean, it's grown from 3 trillion in 2008 to 9 trillion in 2017 and approaching 14 trillion by 2023, and no sign of stopping. So I think one day it'll just be called investments, not alternative investments, because it'll become a staple in your portfolio, just like stocks and bonds, and food is a staple in our lives and a staple in your portfolio as well.
This is definitely something that we've seen, Artem, as well. It used to be back in 2005, 2006, when we were first helping solo 401k investors, back in 2003, when we were starting with IRA investors, that, having even something like real estate in your portfolio, just like you mentioned, it was very niche. But now I think that's such a good way to put it. Alternative investments, they're just going to call them investments, because more and more people are seeing they need to have uncorrelated assets and really true diversification to be able to get those returns for their portfolio.
Yeah, absolutely. And so talking about farmland as an asset class, here we specifically will now be talking about US market. The data we use is from the industry. It's from the University of Illinois, MCREEF, the Nuveen, which is a large institutional asset manager, and others. So this is, what's great. The industry, kind of the more institutional investors, have done tons of work really putting in the right processes and infrastructure around the asset class. So farmland has really done tremendously well in the last 40 years. The returns have been almost 12%, and this is a mix of price appreciation and current income, which comes from either renting out the land to the farmers or having a revenue share or profit share. The volatility has been really incredible, less than 7%. It's a little bit higher than bonds, but much lower than stocks. Correlation, negative to low to most other asset classes. And of course, the long-term tailwinds are substantial. We have growing population and improving diets, On the other hand, we have decreasing supply due to climate change, urbanization. We lost something like twice the size of Massachusetts in terms of farmland from 2012 to 2017 in US alone. So it's tried saying, but buy land, they don't make it anymore, and really it's hard to recover farmland once it's transitioned to another use. And then lastly, we'll talk about this as well, but farmland has done tremendously well, both in periods of recession. 2008-9, farmland was up almost 20%, and during periods of inflation. And I think it's done even better than gold in a lot of times. So it's a great inflation hedge.
This is really interesting. I just want to pause for just a moment here on this long-term tailwinds. So that high demand with decreasing supply, you said that there was an area twice the size of Massachusetts that we lost in farmland from 2012
to 14
now?
million acres, farmland in the United States alone.
Was that lost to development or?
Development, partially. You have areas in the United States that are vibrant farming ecosystems, but then some areas I see in Western Kansas, for example, where you have tiny towns and those towns are dying out. So there's no one to farm the land. There's also the opioid epidemic is very real and it's claiming lives and farmers in those places as well. And so once you kind of the town starts dying, there's no stopping it. And so you also have that being part of the driver.
Wow.
Water availability in parts of California, we expect about 1 million acres to be fallowed or kind of being stopped in farming in California due to SGMA, the Sustainable Groundwater Management Act. So we'll go from something like 9 million acres to 8, 9. And this is it's in California specifically, just to sort of lay people's worries to rest. That's because it's trying to get to sustainable water situations. So it's long-term positive, but that does mean that some farmland that is in areas with poor water will have to be fallowed. Yeah. So looking at farmland on a relative basis, just comparing it to other asset classes, a sort of shorthand that a lot of professional investors use is Sharpe ratio, which is just your returns divided by risk, because returns should not be looked at independent from risk. It's always two sides of the same coin. And farmland has done tremendously well in that regard. We see only maybe in the bottom timberland and listed real assets approaching close to farmland performance. And actually, equities have much higher volatility, of course, and so they haven't done as well. Now you have to remember, of course, we're not saying at all that you shouldn't invest in equities and bonds. We still think it should be core of people's portfolios. But what we think is that adding some farmland, some real estate, some alternatives will really help with the overall portfolio performance. And so this just shows how it's like you never know, right? No one could predict the pandemic, and now commercial real estate, AAA office space in New York that used to be, as good as gold, as good as bonds, is no one wants it anymore. And so you never know. And so that's why it's important to, if you're building a truly diversified long-term portfolio, that adding a variety of investment products is so important. This is just expanding a little bit on the correlation. You can see it's very low correlation to most of the asset classes. Real estate is the biggest, kind of the most correlated asset class to farmland. And like I mentioned, I think this year we'll see a breakdown of that, where certain regions of real estate, certain types of real estate, are permanently impaired, maybe never coming back. And so we'll see, I think, that correlation in hindsight will have gone down for real estate. I mentioned inflation. Farmland actually outperformed S&P 500 by 30+% in the last 5 periods of high inflation, 20th century. Maybe, in the last 10+ years, we got used to very low inflation. And right now the Fed is saying that they are okay with inflation being more than the usual 2% target over the at least near term. So we'll have to see what happens with inflation. There's tons of money being printed. So if you want diversification, so if you want protection against inflation, farmland is a great tool for that, especially raw crops, meaning corn and soybeans. They're literally used in thousands of consumer products. So we call, feed, fuel, fiber, food, the 4 Fs. It's not just your cereal. It's really goes into so many different products. And so when inflation goes up, raw crops are sure to follow. And so that's we almost look at raw crops in our platform as a variety of tips, treasury inflation protected securities, where your rents reset with inflation. So looking at the market of farmland, it's actually $2.5 trillion market. It's huge in the United States, and less than 2% of that is right now owned by kind of formal investors. So a few points to talk about here. One, most farmland is actually owned by families, and almost 70% of farmland is in farms less than $10 million in values. This is very much a family affair. This is very much a kind of small, medium-sized businesses. We tend to think about farming from this perspective that is this large corporations, so billionaires or pension funds who own all the land, and that's couldn't be further from the truth. It's actually probably one of the least investor-owned asset classes out there, probably the least one. I struggle to think what else is out there that has that little part of investor ownership, and so that is rapidly changing, and we'll talk about why. But I think where you find alpha, where you find opportunities where no one else is yet looking. And I think this is a unique large market, which you can actually, as a retail investor, you're always following, hedge funds, institutional investors. You don't have the same time and capital to do the research they do. And in this case, I think you have one of the few opportunities to actually get ahead of this wave of capital that is sure to come. So we'll talk about that. But very interesting market. So kind of what is different, what is happening, why is farmland opening up now, kind of what's going on there. Well, we talked about this proliferation of private assets. We talked about the alternatives. Rachel, thank you for highlighting that as well. I think that's a mega trend that will be in a way defining along with ESG investing in the next 10, 20 years. Supply and demand is very favorable here. And by supply, we mean, in this case, land actually going up for sale. So this is a really important point to note. First time probably in the history of the United States, you actually have a tectonic shift in the nature of ownership, where historically farmland would get passed on to the kids would become farmers, and then grandkids and so on. But now you have two things happening. One, average age of farmer is approaching 60, and two, kids don't want to farm. Everyone's going to the cities. Kids that do stay become much more tech and finance enabled, much more professional. But overall, you're going to have a huge amount of farmland change hands in the next 20 years, almost 70% of 1.8 trillion. And a lot of that will be sold to third parties. And so it just opens up the market for the first time. We talked a little bit about, the demand from population growth. It's actually, we need to grow double the food we grew in 2009 on the same, actually way less amount of farmland. So this is, this is a real challenge. And then lastly, talking about FarmTogether a little bit and starting to get into our solution, and we'll make sure to show the the website and the deals. So we'll get into kind of the nitty-gritty of it. But the technology to access this extremely fragmented market has only emerged really in the last few years. I mean, some of the tech we're using, let's say imaging from satellites, we got only in the last month or two, where the resolution is enough to actually analyze some farms at scale. And so what we mentioned is that it's such a fragmented market that in order to really offer a diversified portfolio, to select the best deals, to really do your due diligence, you have to use tech. Otherwise, you're just stuck spending 5-6 hours driving to a farm, doing everything manual, just doesn't scale. And so I think we've seen in real estate already a lot of success in this more automated model. We're applying it to farmland, while of course always leaving the human to make the judgment call, to make the expert call, but freeing them up to actually spend more time, more energy on that value-added, thoughtful analysis versus having to, look through 100 properties manually through brochures.
This is a really interesting confluence of factors too, Artem. So increase in interest in alternative assets, uncorrelated assets, this generational change of the older farmers who are maybe getting ready to retire, but potentially the next generation is not as interested in picking up, the plow. So there's a maybe ownership change. And then this final piece of it is what you said here is really interesting. 70% of US harvested cropland is in farms that are small. They're less than 5,000 acres in size, and they're less than 10 million in value. So if you have an endowment fund or a foundation or a pension, a lot of times they can't even look at a deal if it's less than 10 million. It's just
less
not
than
worth.
20 or 50 million. When I
Exactly.
was at Ontario Teachers Pension Plan, if you remember, Rachel, back in the 90s, where I think Cindy Crawford, the model was saying, I don't get out of bed for less than, 10,000.
Exactly. Yeah, exactly.
And Ontario Teachers, we wouldn't get out of bed for less than $100 million deal.
Right. Well, and it's
And
just,
teachers just got bigger.
well, and it's interesting because it makes sense, right? If you're a ginormous foundation or endowment, that, placing 10 million, it doesn't move the needle for their portfolio. But what that says to me is that's an interesting market. Like you were saying, creating alpha is about finding these untapped markets. One thing that happens to be kind of wonderful here is we're doing good for the population. We're doing good for humanity, and, making these farms continue because people need to eat. But it is a very interesting sort of little slice of an investment, and specifically at this time too. That's why I said there's this confluence of things coming together. If this was 30 years ago, people might not have been as interested in alternative asset investing. If this was 30 years ago, the farmers would have been in a different life cycle, or a different period in their life cycle where they might not have been ready to retire yet. They would have been at the height of their careers. So it's really fascinating to see all of these things coming together.
Absolutely. No, absolutely. This is just a bit more information on returns in the last 10 years. You can see Farmland in kind of pink line here. Very stable. You have periods of high returns, and then you have sort of periods of more stable returns. But overall, we'll talk about this a bit more. Farmland is kind of the safe and boring investment. Invest and forget. You can invest for 30 years and it'd still be there. We're doing some analysis, and for example, walnuts have been around for something like 7,000 years. Almonds have been around for thousands of years. I mean, there's an interesting tidbit of information where almond milk became popular in, I think, 10th century in Europe because the church said, during fast you can't eat animal-derived products, so people transitioned to almond milk. So the original hipsters, were way back when.
Totally.
Nothing is new under the sun.
I love it.
And so, Farmland, I think, it just provides you with that stability. And, some of oldest farm in US, I think, like 200 plus years old. It's really a piece of history as well. And then this is just a bit more on the returns in the last 10 years. You can see here volatility and returns and stocks, bonds, real estate. I would say overall, when you look at large asset managers like BlackRock, JP Morgan, when they put out their long-term forecast for asset classes, they put something like 5-6% for stocks. So these types of returns as well that we have seen the last 20 years, I don't know if will be repeated for farmland or other asset classes. I think just overall, with low interest rates, all asset classes being bid up, money being printed, you just have to also be cognizant of what does the next 20 years look like long term. I think I'm going to sound like a broken record here, Rachel, but diversification is name of the game if you're investing to reach your financial goals. Okay, so I like this chart a lot. It's actually, diving a bit more in farmland, it's important to highlight it's not homogeneous. You have different types of subsectors here. On the right, you have annual row crop farmland. So the reason it's called annual row crop, it's planted annually in rows. So again, corn, soybean. It's very stable returns. If you look in the bottom left, the income, this is the NCREF index. Look how stable this is. I mean, it's just phenomenal. And this is the rent that was paid by farmers every year. So it's going down a little bit as farm prices go up, interest rates have come down, but overall, it really is that sort of coupon type investment. But then, unlike bonds, it actually, A, moves with inflation, and B, you get this in yellow periods of sort of modest long-term price appreciation driven by long-term trends in farmland prices. We actually historically, farmland grew by 5.9% annually in the last 50 years. Again, we don't expect that to repeat. We typically underwrite about 4% long-term price appreciation, but you do have that as well. And so you get some periods where as commodity prices go up and skyrocket, you get prices moving up, and then periods that are sort of subdued, stable returns. So we think of this as kind of the investment grade bonds, the stable, safe part of their farmland. And we definitely have investors who love this type of deals and understand that it's capital preservation. It's sort of that long-term kind
slow
of
and steady, chugging
slow
along.
as she goes. Yeah. So on the right side is kind of the bad boy of farmland investing. This is the permanent crops. This is your tree nuts. This is your apples. They have high volatility, as you can see here in income. and they even have years of negative farmland price movement. Something remarkable to note on the left, as you can see, is there wasn't a single year where farmland actually had negative returns. There was maybe a few quarters where there was negative returns in price, but overall, income plus appreciation, not a single negative year. And same in permanent crops, you had 1 year here in 2001. So this is because in permanent crops, you have a bit more involved operation. So in row crops, you typically rent out the farm every year. It's paid upfront by the farmer, and it's a 1 to 3 year lease. So you have almost no risk in both the income as well as the land, because it's really hard to screw up, a piece of dirt, as we say, unless you come dump nuclear waste or something. It's really not much you need to do there. Here you have trees, so they need more care. They need a longer term thinking. There's more that can happen. There's also, we know from natural disasters like happening in California right now, in Oregon, although all our farms are safe. But there's more risk here, but returns are commensurately higher. So if in the left you look at row crop farmland, we target returns of about 7 to 9% here annual, and 3-4% cash yield. On the right, we would target more like 9 to 12% returns, so slightly higher returns.
And I know we're going to get into specific deals. Does FarmTogether have exposure to both types of deals so that the investor may choose, or do you specialize in one type over the other?
We do, yeah. We have both types of deals.
Okay.
Yes. Yeah. Right now we have seen as the deals have been selling out really fast, so we are refreshing the supply and increasing our capacity there. So stay tuned. Yeah, just and maybe Rachel, we can also I can share my screen here.
Sure.
I'll talk a little bit about the slide first.
Okay.
It's really simple. We buy the land, the farmer pays rent for land, and then you as an investor buy a share in an LLC. So every deal is in its own Delaware LLC. It's what we call bankruptcy remote. What it means is that you own units in the LLC that directly owns the title to the land. The LLC is administered by a third party called Assure. It's a well-established company in Utah that has over 5,000 of this, SPVs, vehicles under administration. So they provide you with the tax documents, with payouts, and then the management is done oftentimes the management is really just renting it out to a farmer, putting the farm under a long-term contract that is 10 years sometimes with a reputable group. So even if FarmTogether all gets hit by a bus, the farms, you'll still own the farms, they'll keep operating to spec. So there's sort of little of that operational risk of what happens if something happens to FarmTogether. We think it's really important to play to farmland's strength, which is ownership of the land as much as possible. And so we try to structure all the deals that way. A lot of our deals in row crops typically have no leverage, zero debt, and the deals in permanent crops have modest leverage of about 40-50% LTV, which is standard kind of for farmland because it has really good interest rates. Oftentimes, this is 30-50 year mortgages. The government, U.S. government, has a long-term policy of supporting farmers, so there's sometimes additional benefits from that. For example, COVID-related payouts happened, etc. So there's absolutely, I think, overall a floor on farmland as an asset class because it's a national security asset class and it's a strategic asset class for the United States. So I don't see a scenario where suddenly we're not, we are dependent on foreign countries for most of our food. I just don't see that happening. It's so anyway, yeah, sorry, a little digressing here. I'll share my screen just to give your listeners. Oh yeah, can we actually first go through the videos? I'd love to show. So we'll show you 2 deals of drone footage of our previous offerings, and then we'll actually walk you through the deals themselves. But
yeah.
Part of what we're trying to do with FarmTogether as well is to give you a sense of that ownership and emotional connection to the land. So we want to put out videos, we want to put out interviews with farmers to give you updates. We want to also take this opportunity to really educate people on how your food is grown, who grows your food, and so there's more to come. So this is an actual drone footage of a row crop farm in northern Illinois. This is technology is awesome. Like
beautiful.
Think about it's really, and it's for farmers, a lot of them, this is the idyllic life. It's people that actually enjoy doing this. I think for a lot of people in the cities, they can't imagine themselves living in the country. Just the same for people living in the country, they can't imagine living in a big city. And so this is a vibrant farming ecosystem here. So there's thousands of farms. This is all farms. There's tons of farmers that would rent the land, and this land has been farmed for decades, maybe a century. So this is just something that is just a really high quality piece of land, and we will walk you through it in a little bit. If we can jump now, Rachel, to the Yuba almond deal, just to show people there.
Sure.
Yeah, so this is Yuba Orchard. This is a deal that recently closed. This is in about half an hour drive, actually, north from Sacramento. So this is, talking about farming. Sometimes people think it's like very far in the middle of nowhere. A lot of farms are actually not that far from major cities, and so increasingly seeing, people living, in San Francisco, in Walnut Creek, in Sacramento, and being farmers, and a lot more and more farming you can actually do remote as well. So there's a lot of that happening too. And this is a beautiful orchard. This is our investment director. You can see him here flying the drone. It's really good property,
Beautiful.
well managed, good uniformity, which always signals good previous management, double drip irrigation, and just on
And
and
is
on it
this
goes.
almond farm an example of a permanent crop?
That's right, yeah. So meaning that the trees stay for a while. Almonds are the shortest lived trees. They only last for about 25 years. The old ones like pistachios, walnuts, pecans last much longer, 50 plus years. We have some looking at pistachio farm right now. The trees there are from 1974.
Wow.
So I think that's it's once it's kind of it's a gift that keeps on giving.
Yeah, absolutely.
So I'll share my screen now and just give people a sense of.
Yeah, go ahead.
Okay, perfect. So let's see. Let me know. Please let us know if you can see this.
Looks good.
Rachel, looks like okay, perfect.
Great.
So the way FarmTogether works is that first you just register on the website, and it's open to everyone to register. But right now, it's only open to accredited investors, and Rachel will talk about that in a little bit. But the new regulations actually liberalizing what it means to be accredited. So we hope A, to have offerings for non-accredited investors, and B, that if you are non-accredited, you'll be able to become accredited through other means than just wealth or income, which is typically the paths right now. So we put a lot of work into education. We have a wonderful team who's doing tremendous work, just putting it all together in a way that talks about different aspects of investing and really gives you a sense of how to think about risks, how to think about this versus other asset classes, what to pay attention to, what types of deals are there. We always do webinars like this one. You can shoot us an email. We love talking to our investors. So very open door and aiming for transparency here at all times. So this is a couple of deals that you just saw the videos of. This is Doris Farm in Stevenson County, Illinois. This was an estate sale where the family was selling a farm of their parents. They live in the cities. And this, I think, I don't want to misrepresent, but I think it was one of the kind of largest holdings. So just wanted to diversify from one farm to actually a more traditional financial portfolio. So this deal is an 8-year hold with 2.5% net cash yield and 7% net target IRR. The cash yield actually right now is modeled based on current corn prices. If corn prices recover from we think is a historical bottom, then the cash yield IRR would go up. But we always aim to underwrite conservatively. So here you were able to read everything about the deal, download the documents, get high-level information, watch a webinar, see kind of what it looks like. Really just explaining how it works, see what our fees are. This is sort of our proprietary risk reward spectrum that explains the 8 major types of risks and where this property falls on that risk profile. So this is lowest risk offering we've ever had. So you can see the risks that here is 0. Not 0 in terms of 0 risk, but on the ranking scale, it's 0. But the overall risk is low here. And then you can invest in a matter of minutes, including through solo 401k with Nabers. It's really a quick process. And once you do, you can actually see. So we as principals invest into every deal. Some of this needs to be updated, but you can see every deal where it is. You can get an update. You get your K1s electronically. You get your distributions electronically. So everything is kind of here, and we'll be providing more and more updates as time goes by. But it's just, an easy portal to monitor all your investments. Really, if you kind of just want to invest and forget, you can do it. If you want to learn more, be a bit more involved, kind of get more up-to-date information, that can be done as well. So this is all. And I think, that's about it in terms of how the platform works. Really very simple. I mean, everything can be done electronically, and it's open to both US and international investors.
Wonderful. I'm going to reshare the screen just for a moment here. I know that we have many of our clients and people that are opening their solo 401k with us today. So I want to kind of walk through further a little bit of an example because some of our clients have asked us how to invest in FarmTogether with a solo 401k. So first, what we're going to cover is funding, and then we'll do a quick walkthrough again of that online platform with some more specific steps, just as Artem showed. And the information applies here if you have a checkbook IRA with us, or even if you're investing with non-retirement funds. And, for all of the reasons that Artem covered earlier, Farmland is a very interesting investment to consider. I think you really supercharge it when you understand that you're allowed legally to invest retirement funds into an asset like Farmland. I've been a long-term real estate investor, and I love owning properties in my own solo 401k because all of the income that's coming in, the rental income, or in the case of something like FarmTogether, those dividends, those distributions, they're all tax deferred. If you're investing with Roth funds, then they're tax-free. So there's a really interesting opportunity to be able to use retirement funds to access these types of investments, especially since there are many individuals who have the majority of their assets in retirement accounts. So for you to be able to get that diversification that Artem was discussing and have that exposure to these uncorrelated asset classes with a tax-deferred structure is a really interesting play. For some of you, this is going to be old hand. If you're new to the self-directed investing space, then this will tell you a little bit about how to get money into one of these self-directed investing vehicles. We will establish your solo 401k or your checkbook IRA, also known as the IRA LLC. We pioneered the self-directed investing space in 2003. Our founder and CEO created the IRA Association of America. We brought the solo 401k to market in 2006. This isn't really a webinar to talk about the nuts and bolts of solo 401ks versus IRA LLCs. If you have questions about which vehicle is right for you, I'll make sure you have our contact information so you can reach out to us. But for those of you who already have a solo 401k with us, then you know that you can fund a solo 401k from rollovers, from other retirement accounts, and also contribute some of your business earnings to your company retirement plan. The solo 401k has the highest contribution limits of any retirement plan. You're able to put in up to $57,000 per year, tax deferred, tax deductible, or $63,000 to $63,500 per year if you're age 50 or older. So once you've got money in your 401k structure, and we'll walk you through the entire process of getting that all set up, then you're ready to start investing. So you would simply send the funds to the investment sponsor and take the title of the property or have the private placement memorandum or the subscription agreement in the name of your 401k trust. And now this asset is a part of your retirement portfolio. As Artem mentioned, you can complete the online profile in just a few minutes. You'll let the FarmTogether team know that you're investing with your solo 401k, and other types of funds are fine too. Retirement funds, non-retirement funds, an LLC, checkbook IRA, living trust, individual funds. All of them are available to you through their online platform, which is really easy. If you are using the solo 401k that we've established for you, then just let the FarmTogether team know. We work with them on an ongoing basis to make sure that it's really easy for your trust documents or adoption agreement, the subscription process to just go through really smoothly with them. So yeah, this is a great way to bring alternative assets like Farmland into your portfolio. At the end of each year, FarmTogether and their administrator will send a K-1 for your records. And if you invest with your solo 401k, or then you can simply store the K-1. There's no tax return for a solo 401k, so this means a little less paperwork, a little less headache at the end of the year when you're using a retirement account to invest in an alternative asset like farmland. And many of you on today's webinar have a solo 401k or a checkbook IRA with us. I saw many, many names that I recognize. And if you don't yet have a solo 401k plan with us, reach out. We'll be happy to see how we can help, what might make the most sense for you. Each situation is highly individualized, especially when it comes to retirement plans. So we want to make sure that you're establishing the right type of account that's most beneficial for you. But the name of the game is really to get the money in your control. That's where it belongs. It's your money. You worked hard to earn it. So you should decide and have the ability and the control to execute on investments when you're ready. So that's what we specialize in, is checkbook control retirement plans. If you already have a solo 401k with us, then this is easy peasy for you. And if you're still new to the self-directed investing journey, then definitely reach out to us. And if you already know that this is something that you want to pursue, you want to learn a little bit more about it, then you can simply go to solo401k.com/farmtogether, and you'll be able to go right through that sign-up process. And Artem, we actually had some people submitting questions before we even started the webinar. So I know that there's a few that we're going to go through here. I see some questions that are in the chat. We're going to go through as many of those as time allows. There's also some questions that people have submitted in advance. So we'll go ahead and start getting into those. The first question comes from Kevin. This seems to be a bit of a technical question. What is the composite pH level of the soil being presented today? With respect to pH, how does this farm compare to the land in a 5-mile circumference of the offering?
Yeah, that's a very technical question. I'd have to get back to you on that if you can email us. But it's one of the highest soil levels, quality levels in this area. Yeah.
Cool. Okay, excellent. The next question we have here from Philip: does Nabers offer a solo 401k with a Roth option? Yes, Philip, all of our solo 401k plans automatically include both a pre-tax and a Roth component built right in. So if you have questions about your specific situation, feel free to reach out to us at solo401k.com and we can go through your specific situation. Okay, next question we have from Brian. Artem, do you have a detail of yearly crop by crop performance? Which crops do you see typically perform best?
We don't have details of crop by crop. It's a little hard to find, but overall we have performance by regions. That is a proxy for types of crops. And then we have performance by row crops and permanent crops. So as I mentioned, permanent crops perform better over long term, but with higher volatility. We are bullish long term on nuts, citruses, and fruits. We're not touching right now dairy. On corn and soybean, what's great is because it's a rental model and we underwrite conservatively, a lot of the returns are actually sort of a fixed kind of fee, and so you don't have that 100% correlation to crop prices, where most of your returns are kind of fixed. So it's a little bit like when you rent out, let's say you buy a storefront, you rent it out to Starbucks, you don't really care what the coffee prices are because you don't get paid based on coffee sales for Starbucks. So there's more stability there. And then with meat, of course, right now we're seeing a lot of headwinds from both the trade war. China just invested a lot into Argentinian pork production, and we have also plant protein substituting at margins and starting to become more and more mainstream meat consumption. So we mostly focus on kind of the staples and the growing parts of the market. That's a big part of what we as a company do as well. My background, as I mentioned, was investing in food and ag around the world, and so a lot of what we do is looking at the macro trends and underwriting the end prices as well for almonds, pistachios, walnuts. What is driving the consumption of those products? But that's why we also always suggest to diversify. And at the end of the day, there's a certain floor that exists in farmland, where if a particular crop is doing really poorly, you can replant to a different crop. If you have water availability as well, you can maybe move from almonds to something else, because if you have water, then you can grow a variety of things. So that becomes really important. And then look, again, I think we have, nuts, for example, a premium product. And so as the middle class grows, more and more of nuts get consumed. So there's definitely, I would say that's where we are right now. That can change any day. We continuously look and analyze the market. But yeah, it's a great question.
Next question we have comes from Russell. Are these farm investments fractional ownership if you don't have enough funds to buy the entire farm?
Mm-hmm. Yes, so we always buy entire farms, but then you as an investor buy fractional ownership in a single property LLC. You can think of it, as I see some questions here, a little bit like a deconstructed REIT or a single property REIT. The reason we don't call it a REIT is REITs have some very specific legal requirements, so it's not quite a REIT, yeah.
Got it. Perfect. Okay, so let's see. John says, how does one exit this investment if necessary?
Yes, so most of our deals have an 8 to 10 year hold. Farmland, it's not a short-term investment. You shouldn't invest in it as a short-term. We see it as a long-term investment. But having said that, we're developing a secondary market where you can trade your units just like you can, let's say, on some other real estate platforms, so New York Stock Exchange. So there's a pilot happening this year, and we see no reason, technical, legal, or otherwise, that this cannot actually be a fairly vibrant liquid market as well. So definitely, I would be
market.
Secondary market, correct. I would be very disappointed if in 3-5 years you're not able to, easily exit and enter your investment. Yeah, that's a big mission of ours. I think that will open farmland to a lot of kind of in line with our mission to open up for everyone. You have a shorter time horizon. I think it's important you still have some liquidity options here.
And as far as that question, I know that the FarmTogether is open currently to accredited investors. So for those of you who might not be familiar with this term, you may be considered an accredited investor if you have a net worth of $1 million, not counting your primary residence, or if you or you and your spouse have earned $200,000 or $300,000 per year for the last 2 years. So there's a couple of ways you can qualify. The SEC is starting to relax some of their regulations. If you're a registered investment advisor, you have a Series 65 license, you can also be considered an accredited investor. But right now, FarmTogether is open to accredited investors. And I know that the investment amounts, they change with each deal. Artem, do you have a range of what people are looking at as far as getting into any of these deals?
Yes, typically it's 10 to 15,000 minimum. And then, just on your point about accreditation, I believe it's less than 60 days that the new regulations come into effect. So I definitely encourage, if you're not accredited, to check it out. Some of those rules allow you to, I believe, take some training, pass some certifications that are not that hard. I mean, it's still a barrier because at the end of the day, the SEC wants to protect you as an investor. All right, they want to make sure that you are informed when making a decision. But definitely, I mean, I think it's going to be huge for the investment industry and for investors. There's new rules. So hopefully, Rachel, we can do another webinar just talking about that and kind of what are the new laws and rules are there.
Yeah, definitely. And it's a landscape that's changing really quickly. I mean, just going back to what you were talking about with tech, things are advancing really rapidly, and people are having more access to investments that they might not have even known were a possibility before. So like I was saying at the very beginning, growing up, no one tells you and you're going to one day be able to, buy a piece of a farm. That's just not something that's on our radar. So I think as the tech is advancing and continuing to evolve, then that's opening up more and more opportunities for people. It's starting to level the playing field. The reason why the SEC created that accreditation level is because of sophistication, right? For investors, they want you to be sophisticated enough so that you know what you're getting into. So if you lose money in investment, it's your own fault. It's that's essentially what they're doing, right? So That's what they're trying to do. But I think now with the rise of technology, more people are being exposed to more information, more education. There's, hundreds of you here. So that gives us the knowledge that you're able to increase your sophistication. So, okay, we've got another question here. This is an interesting question as far as the economics of what's happening right now. Joseph says, what happens with the collapse of our money? What happens with the collapse of our money? I think he's saying like when our cash becomes trash, how do we pay the taxes? So maybe Artem, speak a little bit to how does the investor responsible for property taxes? Is that wrapped up in the deal?
Yeah, we take care of everything. I mean, it's truly invest and forget. So we pay all the tax. We provide you with an electronic K1, and I think in the future, we'll also see a streamlining of how your taxes are paid and how you manage your investments. I hope we don't see a collapse. I mean, Farmland definitely is a good hedge, but we don't want to see disintegration of civilization, and that's very dark. I think hopefully we are optimists here at the end of the day. So although it's hard today in San Francisco looking at this orange sky. But to answer your question, we take care of everything in terms of paying tax. We pay property taxes as well. We take out insurance. Every deal is insured in terms of the right crop insurance, fire, disaster insurance where it's possible, available, and then again, even in permanent crops, still almost half or more typically of your value is in the land itself. So, coming back even to protecting investors, I think what gives me just sleeping well at night is that, in the end of the day, it's farmland, so it's a real asset. So there's only so much risk that there is in it versus investing in maybe, startups or crypto or stocks where there's just more that can go wrong.
Yeah. Definitely. It's a great question, Joseph. I'm glad you're thinking about this because there's a lot of funny business happening right now in the economy. That's definitely true. What I think is nice that you're discussing here, Artem, is when you invest, you're invested. There's not necessarily, you guys aren't going to have a capital call where it's like, we need to pay the property taxes. You got to give us more money.
Yeah, there's no capital calls.
Right.
Yeah,
once you're invested, you're invested. So then that then is all wrapped up into that. And then Joseph, if you have questions about sort of the larger economic picture of what's happening with all of the quantitative easing, the money printing, how that's affecting, the economy at large, our CEO and founder, Jeff Nabers, he does a lot of research and a lot of training on this. You're welcome to jump onto our next training. These are free. It's a good way for you to learn a little bit more about the economic picture. Okay, Brian says, can you discuss how you qualify the farmer you lease to?
Yeah, so we do really extensive kind of analysis of the farmer. So first, just coming back to the types of products. If it's a row crop farm, you typically rent it out on a once a year basis, maybe once every 3 years, and it's paid upfront. So you don't really care that much about the farmer and the capability because they are taking all the risks. And with the land, the only thing you're looking for really is making sure that they don't do something crazy to the land. Every contract, it's a standard contract. So just something to keep in mind. We talked how less than 2% of farmland is owned by investors, but actually out of the 100% of land in the US, 40% is leased right now, and that's been very stable. So renting land is a very common practice. It's not anything new we're creating here. Sometimes a farmer will own some land, will rent out some land, and will rent some land. And so the standard contracts where you just check for what's called NPK, the fertilizer levels before and after, and if they're not where they were, then the farmer has to replenish them or pay you a little bit to compensate for that. In permanent crops, it's more important. So it's a good question. More important to have the right farmers. Here we work really with experienced farming families. They typically have been around for decades. For them, it's a professional business. They farm for some of the largest institutional players in the space. So this is us kind of leveraging our experience in the industry. I mean, we've been in this industry for many years combined, and we know the right players. We know kind of their reputations. And then also increasingly with AgTech, you can actually get a real life picture of what's happening with the farm. So there's, definitely it becomes easier, cheaper, and better how we select the farmers.
Excellent. Thank you. The next question comes from John. In the interest of full disclosure, what are all of the different ways FarmTogether makes money? FarmTogether is
Yeah, absolutely. Yeah. So right now we charge two types of fees. There's a one-time expense reimbursement fee that you pay at closing, and then an annual management fee. That's all. Once we have a secondary liquidity market, there likely will be fees attached with running that. And then also as a way for us to make sure that we as a business are sustainable and that we can keep the fees reasonable, we're looking to start earning broker fees as well, but that's in the future. Yeah.
Okay. Awesome. There's a question here from the early part of the chat about organic farming, and I'm wondering, Artem, does that play into your decisions when you're looking at deals? Are you comparing and contrasting organic farming versus non-organic? Does that matter? Does that make a difference? Sort of as an end consumer, what kind of walk us through that? What that means on your
Yeah, it definitely matters, and it's part of our broader mission of driving sustainable food systems. We'll also look at regenerative farming. There's two ways we look at it. One is just purely economical. Is this a good deal? And B, we have a lot of investors that actually are okay sacrificing a little bit of returns in exchange for impact. So we filter for those deals as well. Actually, those deals are harder to find just because it's a less developed industry. And we have so many investors who are saying, like, give me a good regenerative deal. So we're working on that. Yeah, absolutely comes into play. And look, organic it's not a new thing. It's mainstream now. I mean, it's maybe a premium segment of the market, but definitely there's a lot of crops that just seem to have insatiable growth in terms of demand. And so we want to position ourselves accordingly with those crops and offer those crops and those farms to our clients.
Excellent. I'm just looking through the chat here. There's a couple of questions. Yeah. Howard says, how soon do you need to set up the solo 401k after you subscribe? This is a great question, Howard, because we do want to make sure things are done in the proper order so that the dividends or the returns that you're receiving remain tax deferred. The first thing that you would want to do, of course, you can reach out to the FarmTogether team. If you go to solo401k.com/FarmTogether, you can begin that sign up process. There's actually a little link on the FarmTogether page that says if you want to sign up for, or use a solo 401k, don't have one, click here. It'll take you right to our website at solo401k.com. So you can concurrently begin the process, sign up with FarmTogether, let them know that you're interested in learning about their deals, and then we would establish your solo 401k for you. We are your IRS plan document provider. We write the plan for your company. So it's a company retirement plan. And then we'll help you do the funding. So that's going to be rolling over money into the solo 401k, making contributions. And then you've got the money in your control. So your steps would be, Howard, go to solo401k.com/FarmTogether. Let them know that you're interested, start that sign-up process, and then we'll establish your solo 401k, help it get funded so that when you have the funds in your control, which usually happens in just a few days, about 3 to 5 days, then you can be ready to execute on the investment as soon as you identify a deal that works for you. All right, let me see. Just taking a look here. Okay, this is a good question from Abel. What are the tax advantages on farmland investments, such as depreciation?
Yep, absolutely. And I'm typing this up as well, so sorry for the furious typing, and then we can also talk through it because not everyone might be looking at the chat. Yeah, there's actually two types of tax advantages. One is it's a pass-through vehicle, so expenses and losses that typically happen when you're doing development. Thanks to favorable tax code in IRS, 100% of expenses is tax deductible until 2023 for now, which we believe might be extended. So you do get a lot of that benefit of the sort of the loss pass through in early years. And then secondly, some farms may fall into qualified opportunity zones, and so you can potentially benefit from that. We don't have deals in those zones right now, but it's definitely something we're looking at and hope to have in the future. In terms of farm-specific tax advantages, there's none that so far have come into play. There might be in the future, but right now it's mostly just benefiting from the pass-through. So, for example, I would say the development can be quite substantial tax benefit. If you think about target IRRs being, let's say, 11% on a permanent crop deal, and if there's a development component, easily can boost your IRR to another 100, 200 or more basis points if you're at that highest marginal tax bracket, which typically as an accredited investor you oftentimes find yourself there. So it's near 35%, 39 federal tax rate, and depending if you're in luckily like me in California with another 8 to 12% income tax rate, you're looking at easily 50%. So that can be quite substantial, and we definitely have investors that filter for that and are looking for that type of benefit.
So this also is just, I think, further reason why to consider using your retirement funds to invest in deals like this. Abel, it's a really good question. You don't have to worry about depreciation or writing off losses if there's no taxes that you're paying on dividends or distributions. So definitely consider something like a retirement account, especially if you have a checkbook control retirement account, such as the solo 401k, because then that rental income or the distributions or dividends come right into your 401k bank account. You receive the K1 and you just put it in your file cabinet. There's no tax return. You don't have to worry about trying to take depreciation or write off losses because all of that income is growing tax deferred already in your retirement plan.
Yeah, and we think Farmland, Rachel, really good point. We think Farmland is an excellent retirement product. I mean, it's one of those invest and forget for 20, 30 years. And over long term, I think the stability of it, as well as tax deferred benefits, you have to remember, there's a big cost associated with constantly monitoring and balancing your portfolio, whether it's your personal cost, whether it's the cost of reinvestment or risk of reinvestment, whether it's the cost of making the wrong decision. And so if it's something that you think is a long-term investment, you've done your due diligence, you should be good to go. Whereas in stocks, especially if you're an active trader, you buy Tesla does great, and Tesla does poorly, you're losing your sleep. Definitely.
And I think that it's important to have, we've kind of harped on diversification a lot, but we do it for a reason. So for my real estate, I call them fabulously boring because that's their job. Their job is to be fabulously boring. And especially if you're investing with a retirement account, the IRS, they want your investments to be passive. Yes. So this is a really good example of that. And we're coming to the end of our time here. We're going to try to get to a few more of these questions. The next question we have comes from Jim. Have you evaluated this farmland investment with regard to the Biden tax plan for investments, real estate, inheritance, et cetera? I know that the election is really on everyone's mind. So we're trying to plan for how different tax strategies might affect us. I put in the last part. The last part was not Jim's question. Jim's question specifically is, have you evaluated this with regard to the Biden tax plan for investments, real estate, inheritance, et cetera?
Yes. So there is what's called a 1031 exchange that allows you to roll, basically sell a property and then roll it into a different like property. And one of the products we have is for investors who are looking to deploy a large amount of capital, let's say 10 to 15K, sometimes it's $1 million, $2 million, $3 million in farmland. They want to buy a farm in their own name, and they can do it tax efficiently by selling a property and then buying a farm. And yes, I believe that Biden has a proposal that would cancel this 1031 exchange. I don't know, he needs to get elected, he needs to pass it through. It's sort of a long ways off, but if it's something you're worried about, then definitely we can facilitate the 1031 exchange fairly easily. And we can also explore with your tax accountant, because it's a little bit dependent on the deals and personal situation, if you can actually 1031 into a fractional ownership of a property on the platform. We've heard so far somewhat conflicting information there. Is something we're exploring. But yeah, look, overall, I think, without getting too much into politics, but I believe, you have cycles, Democrats, Republicans, one taxation regime, another taxation regime that always changes. And so we can work with you and your tax strategy, tax accountants to sort of position yourself for, whatever scenario you think is more likely. We definitely have had increasingly sophisticated, investors come to our platform and are set up to actually do all that fun stuff.
And Jim, I know you. If you're starting an investment with a retirement account, then remember there's no need for a 1031. 1031s are not necessary because there's no capital gains on the returns that you're receiving. So you don't need to tax shelter in a 1031. If it's outside with personal funds, of course, then that's a different story. But if you're entering or exiting deals using retirement funds, then you do avoid the need for a 1031 because you're avoiding those capital gains completely. Okay, we've got another couple of questions here. Ku says, what is your opinion, Artem, on timber farms? I haven't seen many properties that focus on this commodity.
Yeah, it's funny you ask. We have from time to time timber people come to us and say, can we do a deal on your platform that's, a timber farm? Actually, farmland in a lot of ways resembles the path that timber took. Down to the interest of Canadian pension funds that are typically pioneers in this space. And so when I was in Ontario Teachers, for example, back in 2008-10, there was a large timber practice emerging. Farm investing came by 7 years later. And so maybe one day, who knows, but yeah, not anytime soon, unfortunately. Maybe there's a timber together somewhere out there.
Cool. Awesome. Thank you. Okay. I know that you had answered this, Artem, in the chat, but I wanted to just bring this question on screen as well, because I think this is something that some people are wondering about is, are you looking at investing in farmland for hemp farms?
Yeah, so we get this question a lot, and same for cannabis. Have nothing against either, just as an investment for us. Cannabis is not that much farmland related. It's about branding, it's about a lot of other things, and with hemp, it's just such a crazy market right now. There seems like there's a lot of capital, a lot of players, different tax regimes. We just think about farmland as fabulously boring, Rachel, to still borrow your saying. And so we want things to be fabulously boring, and hemp is too fascinating and too exciting for our taste right now.
Understood. Yeah, it definitely seems like it can be a little bit bubbly up and down. Lots of it's very popular. Sometimes you don't always want to go with the thing that's the most popular.
Yeah, so, we exactly.
Yeah. Ku has another question here. Who pays for the annual costs of the properties? For example, fertilizer, maintenance like fences on the farms, grass and weed control.
Yep. So depending on the type of the property, if it's row crops, then it's leased out to a farmer, and so we don't do anything. They're typically well capitalized. The reason they do it is that they have a fixed asset base, expertise, labor that they can spread over more acreage. So they actually prefer to rent. In permanent crops, where it's when it's not a revenue share but a profit share, or what's called a spec operated or direct operated farm, the LLC is responsible for all the costs. And the manager typically there will draw on an annual budget, so requires a bit more involvement from us. But we have people on the team and our advisory and consulting board that have done this for decades, have managed some of them more than 20,000 acres. So it's not anything new or unusual for us. But that's kind of how it sort of fluctuates. And we always leave substantial reserves on the farm to make sure that we cover for outsized risks or one-off risks in expense line items. Yeah.
Awesome. All right, guys, we'll do one last call for questions here. It's been really awesome. Thank you so much, Artem, for being with us today. It's really special to get to learn about an investment that I think many of us maybe didn't consider that would be accessible for our portfolios before, especially being able to use tax deferred or tax free funds in a retirement account is probably something that most people have never considered before. So if you would like to learn more about FarmTogether, then we encourage you to check them out online. If you're ready to learn a little bit more about specific investments, then you can go to solo401k.com/farmtogether. And if you're new to our community and you want to learn more about how to take control of your own retirement funds so that you can access alternative assets like farmland, then definitely reach out to us at solo401k.com. I don't see any new questions coming in here. If you do have questions still, feel free to put them in the chat. We'll make sure that one of the solo401k.com or FarmTogether team gets back to you. And Thank you so much for being with us, Artem.
Oh, thank you, Rachel. This was great. Really appreciate it. A lot of really thoughtful questions. You have a very sophisticated audience. I mean, I'm sorry I couldn't get to the pH question. It's very specific. If you want to email us afterwards, I couldn't get that information.
Cool. All right.
Um,
Thanks so
all
much,
right.
everyone. Have a wonderful rest of your day, and we'll see you soon.
All right. Thank you.